Hi, I'm Inji Nazif and I'll be presenting a valuation of L'Oréal based on organic growth. First of all, I'm going to talk about the assumptions and the equations I used in this presentation. I calculated the growth rate such that the additional funds needed would be almost equal to zero. So here I found that the best growth rate was like 1% for the 5 years. I also use the equation for the weighted average cost of capital, which is the cost of equity times the weight of equity, which is equity over the total equity and debt, plus the cost of debt times debt over equity plus debt. The cost of equity is equal to the risk-free rate plus the beta value of the company times the market premium. And the cost of debt, I calculated it as the interest expense divided by the total debt. For the risk-free rate, I used the 10-year Treasury constant maturity rate, which is a value that can be found online. And for the market premium, I found that for L'Oréal, it was about 7.5 to 8. So I chose 8%. And I chose a tax rate of 25% that I calculated using the EBIT and the taxes. And I assumed a dividend payout ratio of 70%. Because as I looked through the financial statements of L'Oréal, I realized that they paid a lot of dividends. Okay, so for the weighted average cost of capital calculation, on the top left, I calculated the average of 2 years of debt, total debt. This means long-term and short-term. And here I calculated the same thing for the equity and its average. This is total the average of the debt plus the average of equity. And here, according to the previous equation, I calculated the weight of equity and the weight of that year. It is important to notice that year 1 is 2013 and year 2 is 2014. Then I calculated the interest. Then I got the cost of debt using the interest and the debt, which is about 2%. Then I found on Google Finance and Reuters, I found a beta value for L'Oréal of 0.65. And for the risk-free rate, I found that in 2014, the risk-free rate was between 2 and 3. And so the cost of equity here is 7.73%. Putting all these numbers together, we get 7.38% for the weighted average cost of capital. Then I used the income statement and the balance sheet of L'Oréal to be able to project income statements for the planning period of 5 years. So here I added an extra row to calculate the free cash flow, which I calculated using the EBIT minus the change in working capital minus capital expenditures plus depreciation and amortization. Here I calculated the balance sheets for the planning period, and here I used an extra row right there to calculate the working capital, which is the current assets minus the current liabilities. Then, using the equation given in the book, I calculated the present value of the planning period, which is 41.6 billion euros. Then I calculated the present value of the residuals. In my calculations, I used the weighted average cost of capital of 9% and I assumed a growth rate of 1%. The screenshot of the book is where they calculate for the example of the Bruce company. So I calculated it and it gave me 73.2 billion euros. Finally, the total valuation is the present value of the free cash flow, which is the present value of the planning period, plus the present value of the residuals. In total, it gives us about 115 billion euros, which is a lot closer than what I found previously for the value of L'Oréal to the market cap, which is 87 billion euros actually. Thank you.